The Scandinavian liquidity experiment. It began as an idea so clean and rational that almost no one questioned it. What if liquidity could be engineered to be permanent, smooth, and crisis-proof? What if banks never needed to fear sudden shortages, and markets never needed to seize? In the Nordic world of precision and trust, the experiment felt not only possible, but inevitable. To understand why Scandinavia chose to redesign how liquidity itself behaved, we need to return to a region shaped by extremes. Small open economies, heavy dependence on global trade, long memories of past banking crises that arrived suddenly and cut deeply. Stability here was never taken for granted. It was planned, tested, and refined. When volatility struck elsewhere in Europe, Nordic policymakers asked a different question. Could they remove volatility from the system entirely? The answer took shape through a framework of proactive liquidity support. Central banks expanded facilities. Banks were encouraged to hold buffers far above international norms. Funding markets were structured to remain open even under stress. Liquidity was no longer a backstop. It became a constant presence, embedded into daily operations. For years, the results looked remarkable. Credit flowed steadily. Confidence held firm. Crises that rattled neighbors barely registered. At the center of the experiment stood a belief shared by regulators and bankers alike. If liquidity is always available, panic loses its power. Depositors stay calm. Markets stay rational. Time can always be bought. It was a compelling logic, reinforced by data that showed resilience through multiple global shocks. Scandinavia appeared to have solved a problem that haunted every financial system, but systems that work exceptionally well invite quiet dependence. Banks structure themselves around continuous access to central bank support. Funding strategies assume smooth rollovers. Risk models adjusted to a world where sudden freezes no longer featured prominently. Liquidity stopped being a contingency and became an assumption. Early signals emerged slowly. Balance sheets grew more synchronized. Asset choices converged. Institutions that once behaved independently began reacting in similar ways, guided by the same incentives and safeguards. Nothing broke, nothing failed, but diversity, the hidden absorber shock, began to thin. Inside policy circles, a subtle unease formed. The experiment had removed visible stress, but it had also changed behavior. The question was no longer whether liquidity would be available. It was what that certainty might be encouraging beneath the surface. Because when protection becomes permanent, risk does not disappear. It adapts. And in Scandinavia, the conditions were quietly forming for the experiment's first true test. The experiment's consequences did not appear as excess or recklessness, but as alignment. Banks began to look alike. Funding profiles converged. Asset allocations clustered around the same models, the same assumptions, the same definitions of safety. Liquidity buffers were ample, but they were held against risks increasingly shared rather than diversified. Within individual institutions, risk committees noted the shift but struggled to challenge it. After all, the system was performing exactly as designed. Stress tests passed with ease. Market confidence remained high. Profitability was steady, not explosive, but reliable. The absence of crisis reinforced belief in the framework. If nothing was breaking, why interfere? Yet beneath the surface, a subtle fragility grew. Liquidity support smoothed outcomes so effectively that price signals weakened. Funding costs no longer reflected nuanced risk differences. Markets stopped differentiating sharply between institutions. Discipline softened, not through negligence, but through reassurance. When liquidity is abundant, urgency fades. Central banks observe the same patterns. Their facilities, once designed for emergency use, had become part of routine funding. Intervention blended into normalcy. Each adjustment felt incremental, justified, even prudent, but taken together, they transformed the system's behavior. Liquidity no longer absorbed shocks after they occurred. It shaped decisions before they ever emerged. Then external pressure arrived, not as a crisis, but as a shift. Global rates rose modestly. Currency volatility increased. Asset prices adjusted unevenly. In other systems, these changes would have produced clear signals. In Scandinavia, The signals were muted. Liquidity absorbed them, delaying reaction and compressing feedback. Banks responded uniformly. Hedging strategies aligned. Asset sales clustered. Portfolio adjustments happened simultaneously rather than independently. The very mechanisms designed to prevent panic now synchronized response. The system remained calm, but calm was becoming deceptive. Inside policy discussions, concerns sharpened. What happens when everyone adjusts at once? Liquidity can buffer individual stress, but when behavior converges, buffers are tested collectively. The experiment had reduced volatility, but it had also reduced diversity. And diversity is what prevents systems from moving in lockstep. The warning signs were no longer theoretical. Stress scenarios showed that under certain conditions, liquidity demand could spike simultaneously across institutions. Facilities designed for support might become pathways for transmission. Protection could become propagation. The experiment had not failed, but it had revealed a paradox. Stability engineered too perfectly can change the system's geometry. And when geometry shifts, pressure does not vanish. It accumulates. The question facing Scandinavia was no longer whether the experiment worked. It was whether it could be adjusted before its success became its vulnerability. The tension surfaced during a market adjustment that should have been routine. A repricing in global assets nudged yield higher, and thin margins across funding markets. In most systems, responses would have varied. In Scandinavia, they aligned. Banks adjusted positions within the same narrow window, drawing simultaneously on liquidity, facilities designed to smooth precisely this kind of movement. What followed was not panic, but pressure, quiet, synchronized, and revealing. Liquidity dashboards lit up across central banks, showing identical patterns repeating institution after institution. Usage surged, not because any single bank was distressed, but because all were responding to the same incentives at the same time. The buffers held. The system did not seize. Yet the data told an unmistakable story. What had been designed as individual protection was now behaving like collective exposure. Inside policy meetings, urgency replaced abstraction. Models that once showed resilience now displayed convergence risk with uncomfortable clarity. If a larger shock arrived, liquidity demand would not cascade gradually. It would arrive in a wave. Facilities could absorb it, but only by expanding balance sheets in ways that carried long-term consequences. The experiment had shifted risk from banks to the system itself. Executives felt the change as well. Treasury teams noticed funding flexibility shrinking at the margins. Minor delays appeared in settlements that once cleared effortlessly. Asset prices adjusted not through volatility, but through uniform repricing that left little room for maneuver. Stability had become brittle, not because it was weak, but because it was shared too evenly. Regulators faced a dilemma they had not anticipated. Intervening too aggressively risked reinforcing dependence. Stepping back too far risked allowing synchronized stress to build unchecked. The tools worked, but their very effectiveness demanded restraint. Liquidity could no longer be treated as a neutral resource. It had become a shaping force. Publicly, nothing seemed wrong. Markets remained orderly. Confidence held. Yet inside the system, the awareness was unmistakable. The experiment had reached its inflection point, not a failure, but a decision moment. Continue as designed in risk amplification, or recalibrate and reintroduce friction where smoothness had gone too far. The question was no longer whether liquidity could prevent crisis. It was whether too much certainty had removed the system's ability to respond differently when conditions changed. And in that realization, Scandinavia confronted a truth that few financial systems ever face willingly. Stability is not only about strength, it is about variation. And variation, once engineered away, must sometimes be restored deliberately. The next move would determine whether the experiment matured or whether its elegance would become its undoing. The recalibration came quietly, almost imperceptibly to the public. Central banks adjusted liquidity terms not to withdraw support, but to reintroduce difference. Access windows were staggered. Pricing varied subtly by profile. Incentives were reshaped so that institutions no longer responded in perfect unison. The goal was not restriction. It was asymmetry. Banks adapted gradually. Funding strategies diversified. Treasury desks rebuilt optionality they had not needed in years. Some institutions leaned more on markets. Others rebuilt internal buffers. The system did not lose stability. It gained texture. Movement slowed in places and accelerated in others, restoring the uneven rhythm that absorbed shock rather than reflecting it. The impact became visible only in hindsight. Stress tests showed reduced synchronization. Liquidity usage spread over time instead of clustering. Asset adjustments staggered rather than aligning. The experiment had evolved. Liquidity remained abundant, but certainty no longer dominated behavior. Scandinavia did not abandon its framework. It refined it. Policymakers acknowledge that permanent protection reshapes incentives just as surely as scarcity does. By restoring friction deliberately, they preserved resilience without inviting fear. It was a rare course correction made before crisis demanded it. Europe watched closely. The lesson traveled quietly through regulatory circles. Stability cannot be perfected without cost. Systems must be allowed to express difference, even inefficiency, to remain alive. Smoothness, taken too far, erases the signals that guide adaptation. The Scandinavian liquidity experiment did not collapse. It matured. It demonstrated that the most advanced systems are not those that eliminate stress entirely, but those that allow stress to appear early, unevenly, and manageably. Because in finance, resilience is not the absence of pressure. It is the ability to feel it without breaking. Sometimes the smallest shift in perspective becomes the beginning of a new future. The